Hey everyone, and welcome back to another episode of the Financially Fit Podcast. I am your host, Andre Creighton. Thank you so much for being here with me today. As always, I'm really excited for our topic here today. Today, we're going to talk about feeling the future, which is about funding and financing options. On the last episode, we talked about growing gains and knowing when and how to hire. Over the past few episodes, we've talked and walked listeners through building a foundation, which was our fitness test, bootstrapping, credit, budgeting, pricing, cash flow, and maybe you've started generating revenue and maybe have added to your team. And now the question is, how do I scale without running out of cash? So today, we're going to walk you through some options that you may have. But first, I want to thank those that continue to listen to our podcast. I really appreciate it. Our numbers are increasing every single week. So please continue to share this with other founders, entrepreneurs, business owners that may need to hear about our various topics. And for those that are new here today, thank you so much for tuning in. I hope that you find something fruitful out of our conversation today that will help drive your growth within your business and help you continue to scale. So today, let's jump right in. So our core talking points today is self-funding. So this is really bootstrapping 2.0, debt financing, equity financing, alternative funding, and then how to decide what's right for you. So the first one, let's talk about self-funding. So maybe you have gotten to a point and you don't want to take on investor dollars, or maybe your company is not VC backable. Maybe you can't get money from family offices. Maybe your friends and family aren't interested in the business proposition, and you have to continue to self-fund. So there's lots of different opportunities for this. You obviously could continue to inject your own capital into this. There's ability to, if you're generating revenue and profits, you could reinvest those profits. And I always say that whenever you're scaling a business and you're generating revenue, you should be thinking about, from a strategy standpoint, how much of that revenue am I setting aside for runway, and how much of it am I reinvesting back into the business to continue to grow. So obviously the advantages of self-funding this is it provides you full control. You're not giving up any control within the business. There aren't investors in the business that have ownership and can steer the way that the business is being controlled or the way that the business should be operating. And then there's no debt. So obviously some of the limitations here is like growth is typically a lot slower, right? Because you're using all of your own capital or even the business capital, working capital to be able to grow. So oftentimes, like, you're highly dependent on, one, how much liquid cash do you have available personally? And then two, how quickly are you turning your accounts receivable and revenue to be able to drive growth within that business? So it's not that it's a bad option. It just means that you need to be comfortable with that growth may be a little bit slower unless your company is growing really fast from a revenue perspective. So then number two is debt financing. So small business loans, lines of credit, SBA loans, like these are all great options. And what I will tell you is that we want to be conscious of the rate environment, right? So when rates are really high, loan debt may not be a great vehicle. When rates are really low, like, obviously you want to be able to leverage that debt and be able to utilize debt to drive growth. At the end of the day, what you should be looking at is the acceleration of how much interest am I paying based on my current rate of the debt versus how fast is the revenue being generated. And whatever that delta is, is really what it comes down to. In banking, you can think of it similarly, where a bank is providing debt or loans to individuals, companies, whatever it may be. And then they also have the deposit side, right? When I was working in the bank, there was always this balance of us understanding our liquidity and stress testing that. We wanted to make sure that we weren't getting upside down. We were providing too many loans, and then we didn't have the deposits to be able to support, and vice versa, right? So we want to make sure that we're being very intentional about understanding what is the rate environment, how is that impacting our growth, and are we growing at a rate fast enough to be able to continue to pay these debts and have the cash flow that we need for our business to keep running. So The pros obviously are we maintain ownership, very similar to self-funding. The cons are repayment pressure, right? So we know at some point that there's a maturity on whatever said debt that we have, right? And we need to be able to fulfill that maturity, right? Because we want to be able to create good, sound business credit that allows us to be fundable and have that ability and leverage to use debt later down the line if we need to. So it's more it's more of an art of making sure that we understand our cash flows, understand how our business is operating, and understand our metrics, right? And that will determine whether or not debt makes sense to you, sense for you, I should say. So number three is equity financing. So there's lots of ways that you can do equity financing. You could raise money from friends and family. You could raise money from angel investors. You could raise money from venture capital. You could raise money from family offices. All of those are sound opportunities. It just depends on where your business is. So most pre-stage companies, they're really focused on that friends and family round, and maybe even some in angels. Seed round is certainly more angels, and I would say small funds. And then beyond seed round, that's when you start to get into more potentially even more sophisticated angel investors, maybe some larger VC funds that require maybe some more control over your company. Maybe that's board oversight, maybe that's actual board seat. So we want to be conscious and understand where our business is and why it would make sense and at what time it makes sense. So the pros of that is obviously bigger growth runway. So like you're getting an injection of a lot of capital. You can then be planful of like how I'm going to use that capital, how much runway do I have, and what are the milestones that I want to hit within that runway, right? The things that we have to be careful of is one, our valuation, making sure that our valuation makes sense, making sure that, and the reason why that's important is because if we can't prove out our valuation in hitting the milestones that we were supposed to hit with that capital injection, then we risk having a down round. And obviously, a down round is where maybe we are at a $5 million valuation. We weren't quite able to prove it out. Maybe we proved out 3 million of that 5 million, and then maybe in the next round that we raise, because we're running out of money, now we're raising at a 3 million valuation, which is considered a down round because it's less than the round that you raised prior. So we want to be very careful and conscious of that as well. And then the cons are, obviously giving up ownership and control. So as I mentioned, whenever you're taking on institutional capital, most certainly those individuals might be asking for potentially maybe preferred shares. They might be asking for board oversights. They might be asking for pro rata, where they're able to invest in future rounds at a pro rata rate. Maybe they are asking for actual board seat, where now they're influential on how the business moves forward and in the boardroom. And then obviously having fiduciary responsibility over the business from a governance standpoint, and also the CEO, who likely is the founder. So we want to be very careful when we are taking on equity from VCs. And I always tell people that like not all money is good money. My dad used to tell me that when at a very young age, like there sometimes it may be easy to get money, but it doesn't mean that that money is good for you. Obviously it's really nice to have the capital injection to be able to grow the business, but also what else are they bringing to the table? Are they bringing connections to your customer profile? Are they bringing social capital to other investors that could help you later down the line? Are they bringing maybe specific functional expertise, whether that's like sales or marketing or accounting and finance or legal, right? We want to make sure that at the end of the day, we are taking on money that's not only helping us grow from a capital perspective, but also helping us grow from a knowledge and connection perspective as well. So be very careful as you're thinking about that. Alternative funding options, there's plenty of sites now that do crowdfunding, so where you could post your business on a site, and people can, like myself or individuals, can invest into those companies from a crowdfunding standpoint. Oftentimes those don't come with a ton of social capital because they're so removed from the business, and oftentimes those are in the form of like a safe note, which means that they don't have equities today, but once we raise a price round, that converts into equity later down the line. So, oftentimes those investors, while they're invested in your company, they're oftentimes kind of arm's length away. Grants are another opportunity depending on what is the type of company that you're running. They're really hard to get if you're not a nonprofit, but sometimes we do see that, specifically like healthcare or health tech companies or med device companies, they often have ability to get, some of these federal grants or local government grants that may be driving, maybe they have a thesis focused on a specific medical outcome. So that's an opportunity. And then obviously revenue-based financing. So maybe you have strong revenue and you don't want to give up equity. So maybe you're taking out a loan against that equity and you're getting certain tranches of capital, and then you're paying that back as revenue continues to increase at a certain percent over time. So we obviously want to be careful there. We want revenue to be predictable. If revenue is not predictable, like it's probably not a good idea for us to engage in something like that. And then lastly, community investment funds. So these are, oftentimes going to more social or environmental impact businesses. So, depending on what your business is, like community investment funds could be an option as well. So, these are creative. These are obviously much less traditional paths. There's a lot of things that have to be going right for you to be able to get some of these alternative funding opportunities, but they certainly are out there. And then lastly, like how do you decide what's right for you? So you want to match your funding type to the stage of growth and risk tolerance you have. So this is where, just like you forecast out your cash flow and like the operations of your business, you want to forecast out how you're going to raise capital, or like how you're going to grow capital on your balance sheet. So that could be investors, that could be self-funding, that could be some alternative funding opportunity, that could be debt, right? We want to make sure that we understand the holistic picture of like how we're going to grow, and we want to have multiple scenarios, right? Because we don't know what's going to happen in the economy. We saw the pandemic, that brought a lot of uncertainty. We saw now with a new administration, and most times with any administration, regardless of what public or political side you're on, like there's always changes when a new administration comes in. So we want to be conscious of like the timing and understanding like what is the potential new administration bringing to the table for small businesses and entrepreneurs, and how will that impact me over time. So a key reflection I want you to think about is: do I need cash for survival, or is or fuel for scaling, right? And we want to understand like at what point and like what milestones are we going to hit with that cash that we need for survival or for fueling our scaling. So just like fitness supplements, you don't need them to grow, but if used right, they can accelerate results. The wrong ones, though, can do more harm than good. So just like on the supplement side, when you're on your fitness journey, the same is true here. What you put into your body will affect you over time, whether good or bad. The same thing about your business. What you put into your business will affect you good or bad for your business over time. So we want to be very strategic about what we're doing here and driving that forward. So I have experienced all of these things. I have raised a couple rounds of capital as a founder myself. I've helped other founders with introductions to capital. I have helped other founders with banking relationships that have turned into them being able to get small business loans. So I've seen lots of breaths of how to get capital injection, and it's not a one size fits all. What I will say is it truly matters, like what do you want your end outcome to be? And I know sometimes when you're first starting a company, it's hard to understand like what is the end result that I want. And that doesn't mean that that can't change over time, but we want to have a good vision of what that could look like. And as our company continues to grow and scale over time, like we continue to revisit, like, what is that end result I want? Maybe when I started it was I wanted a $100 million exit. Maybe now as I've scaled the business, I realize that's going to take too long to get to. Maybe it's a $50 million exit, right? So we want to be conscious of what that looks like and continue to evaluate that over time. So hopefully today, like you learned something about like funding and how it can impact your business and the different ways that it could also stress your business. And we want to be intentional about what makes sense for our business. So with that said, thank you so much for tuning into the Financially Fit Podcast. I am your host, Andre Creighton. I look forward to speaking with you on the next episode of Financially Fit. As I always say, it's not about how much money you make. The power is in how much money you keep. Thank you so much. See you in the next episode.
You know Shaletta makes you laugh, but did you know Shaletta Brundage can also make you think and boost your business? Media personality, activist, and comedian Shaletta Brundage founded Shaletta Makes Me Laugh to celebrate and share the best of Black culture. It's a podcasting platform. You can download 10 weekly podcasts hosted by African-American subject experts at ShalettaMakesMeLaugh.com or wherever you find your favorite podcasts. ShalettaMakesMeLaugh.com is also a production house, creating broadcast quality commercial content. And Shaletta and her team of storytellers create powerful promotional campaigns to get businesses the brand awareness they're looking for. Some of Minnesota's top businesses trust Shaletta, and you can too. Get out the word about your events and products and get in front of communities of color with ShalettaMakesMeLaugh.com. She's got the power to help your business.
To keep my home running smooth, I count on Xfinity Internet. With 99.9% reliability, we're all online at once. No slowdowns. The Xfinity app lets me manage our Wi-Fi and keep things secure. Xfinity makes it easy.
When she walked in on her first day at Doherty Family College at the University of St. Thomas, she didn't know a soul.
I'm Zion, and I'm a second year at DFC.
A year later, and so many changes for Zion.
I love my friends here. I couldn't do anything without them. We support each other all the time.
At Doherty Family College, Zion also finds support on the academic side. Like all DFC students, Zion can count on a team committed to her success. Doherty Family College is Minnesota's affordable private college option. DFC students earn their associate's degree and then can transition to a 4-year college or university for their bachelor's. Many are students of color or first in their family to go to college.
It's nice to see people that look like you pursuing an education, wanting to succeed academically.
Zion encourages any high school student looking for a college home to do what she did and apply to Doherty Family College.
All the support you can need is here.
Ready to make your move and experience Doherty Family College for yourself? Then schedule your visit to the Minneapolis campus at dfc.stthomas.edu/visit.